Hi, I'm Jenny Brown. Welcome to this week's MFB News. I hope you're all very, very well. Sorry to not be with you last week. I had a week off and went to Marrakesh. It was very, very lovely, very hot and very busy, and I got the flu. So a really nice break, but probably one to put down to experience in some ways. Now, obviously, last week we saw base rate come down by 0.25%, which was not unexpected. But what we've also seen is a bit of a surge in fixed rate mortgages. So this week we're going to have a slightly different episode of MFB News, and we're really just going to talk about what's going on with interest rates, why are fixed rates increasing even though base rate has gone down. Okay, so the first thing we need to understand is what is a swap rate. Now, apologies if you watch this video often because you know that I talk about swap rates all the time, but I think it's just worth recapping what's going on here. So first of all, when mortgage lenders are lending you money, often they are going to what's called the capital markets, so other financial institutions, and borrowing the money from them, and they're paying interest to these guys and then lending the money back out to you. So it's kind of a sort of layered process, as it were. So these guys have been charged a rate of interest for the money they're borrowing to then re-lend back out. Now, when they're borrowing on a fixed rate basis, they're lending on what's called against swap rates. So swap rates are fixed price loan arrangements, essentially. So a lender will borrow money in based on a swap rate, a fixed rate basis, and then re-lend it back out to you on a fixed rate as well. So when the swap rates decrease, the lender's cost of funds, their interest rate has come down, which means that they can afford to charge you less on your mortgage rate because their costs have reduced. If swap rates were to increase, then of course the lender needs to increase what they're charging on their fixed rates to make sure the numbers or the books balance out, essentially. Now, what are swap rates? So swap rates are not a reaction to base rate changes. Swap rates are a prediction of what's going to happen to base rate in the future. And that is why when we see base rate reduce, more often than not, we don't see a huge amount of reaction from the capital markets in terms of swap rates, fixed rates, and you won't see lots of lenders slashing their fixed rates in response to this, because actually the lenders have already predicted that base rate reduction previously. So what's happening is they're actually looking to the future. So keeping all of this in mind, what we need to now think about is what's been happening in the last few weeks that would cause the capital markets to be concerned about the rate at which base rate is going to reduce. Because if you think about it, and what they're essentially doing, and this is kind of very Jack and Jill kind of explanation, so I'm sure anyone who's an economist watching this will be absolutely kind of fuming, but I'm just trying to make this as kind of straightforward as I can. When lenders are looking, or in the capital markets, they're looking at the cost of swap rates. What they're doing is looking at the average cost of base rate over a period of time. So for a 2-year fixed rate, what is base rate going to be over the next 2 years? If it's a 5-year fixed rate, what is base rate going to be over the next 5 years? And the general consensus in the market was that actually, based on various things, and I'll come into that in a moment, that have happened in the last couple of weeks, they think base rate will still be reducing over the next 2, 3, 5 years, but it's going to be at a more slow rate than previously thought. And this means that the average base rate over a 2-year period or a 5-year period is actually going to be higher than previously imagined. Therefore, swap rates have had to increase to essentially take this into account. So hopefully that kind of makes sense in terms of the way that swap rates are priced and in terms of the impact that has on mortgage lending rates. Now, with this in mind, all of us would be thinking, but inflation is coming down and, base rates come down and there's always kind of better news in the market. So why on earth are swap rates increasing? And just to give you a kind of view of where we are at the moment, because it's important to understand this. So 2-year swap rates are currently at 4.2% and 5-year swap rates are at 3.97. This is 0.2% higher than each of them were 1 month ago. So the lender's cost of borrowing the money in to re-lend back out to you guys has increased by 0.2%. Now, over the last week, actually swap rates were even higher than this. So the difference month on month would have been even greater. Things have come down ever so slightly. So this means that actually the cost of funds to the lender has increased and therefore they've had to put up their fixed rates. And that's why we're seeing a lot of reporting of lenders putting their fixed rates up despite the fact that base rate has just come down. So why are those capital markets being a little bit unnerved? So I'd love to blame all of this on Rachel Reeves and her autumn statement, which has actually knocked the market to some extent. So as we know, in the autumn statement, there was a lot of talk around public spending, huge amounts of public spending over the next few years, and that can be inflationary. So that's thing number one that's kind of contributed to this. The announcement of US tariffs of 10% on imports also coming into play. While this is expected to have a minimal impact on UK GDP, the tariffs could be stagflationary for the UK, which could cause the MPC to cut their rates more slowly. In addition to this, there's higher inflation forecast for 2025. Unemployment is still, relatively low. It is actually increasing very slowly, but actually relatively low. And wage growth is proving particularly stubborn as the labour market remains really tight. So there's lots of things at play here, but actually, essentially what's going on in the capital markets is they're just thinking that actually inflation is going to be higher than it really needs to be. And there's lots of other stuff going on, which means that actually the expectation is that base rate is going to still come down over the next couple of years, but more slowly than previously thought. So where does that leave us in terms of expectations on base rate numbers? So as we know, we're going to finish this year on a 4.75%. I mean, a year ago, we'd been so grateful just to have heard that number, wouldn't we? In terms of going forward and looking to the future, expectations have been revised slightly, and there's obviously lots of different thoughts on this. But whereas we were expecting potentially 4 base rate reductions next year, so essentially 1 per quarter, it's probably looking more likely there's going to be 3 reductions next year. Moving beyond that, more reductions to come, but again, more slowly, more measured than previously thought. So essentially what we're saying here is that the base rate will be coming down more slowly than previously thought. Therefore, swap rates have had to react accordingly, which has meant the lenders' cost of funds have increased. Therefore, they've had to increase fixed rate mortgages. Okay, so finally on that note, really just to kind of ask the big question of what's going to happen with fixed rates? Are they going to come back down again? What should I do if I'm in need of a mortgage over the next few months? So in terms of where we think things are going to move with regards to swap rates and therefore fixed rates, I do actually think there is an element of knee-jerking in the capital markets at the moment. So a kind of reaction to all the various news that we've talked about with regards to the US tariffs and the autumn statement and all that kind of stuff. So I do think that actually we'll see things calm back down again. So we might see probably by the end of this year, swap rates soften a little bit and therefore fixed rates come down, but only ever so slightly. Nothing major is going to really change here. So you might see rates come down by circa 0.1, 0.15%, something along those lines. And this is keeping in mind the context that lenders have increased their rates over the last couple of weeks by between 0.2 and 0.5%. So some big increases there. So I think we are going to see things start to ease. And then as we go forward in time, you will start to see fixed rates start to ease back down again. Now, in terms of the kind of question, which I think is really the bigger one, which is for those people who are in need of a mortgage over the next few months, you've got deals ending, you're thinking about investing in a new property, what should you do? The advice that we are giving to our clients is this. It's best to lock in a rate now, because then you've got something which is potentially a worst case scenario. So if you take a mortgage rate now, most lenders at any point before completion will let you move on to a lower interest rate from their product set if they bring out new lower rates at any time before you've drawn down the funds. Now, some lenders will allow you to do this for free. Other lenders charge you a small administration fee. It's normally like £150. And so really what we would suggest that you do is take a rate now, so you've got something, but if at any point before completion, the lender does drop their interest rates down, you can move on to this new lower deal. That way you're kind of hedging your bets in a kind of really efficient way. Now, I've had a few clients who maybe sort of 6 to 8 weeks ago were saying, oh, I'm going to need to remortgage, but I'm just going to wait for interest rates to come down. Everybody in the press is saying that rates are going to come down, so I'm just going to wait for that. And we had the same conversation about locking in a rate and being able to kind of move it over later. No, I'm just going to wait. I'm very, very happy with that. So these guys are now at the point where they now need to actually do something, and their rates have actually increased. So this is to kind of really give you the example of why actually booking a rate and hedging your bets is actually a really, really it's a really sensible thing to do, and absolutely something that we would encourage you to consider doing. And that's it for me this week. So I really just wanted to kind of come and explain what on earth's going on, because I know I've had quite a few people saying, why are rates going up? Base rates just come down. So I think it's really important that everybody understands this. Now, in terms of kind of lender behaviour in the last week and what's been going on, I mean, lenders are repricing upwards on their fixed rates. They simply have to. So rates have been going up. I mean, again, as I mentioned earlier, between 0.2 and 0.5%. There's been no real criteria changes. I think everyone's just busy kind of watching the markets at the moment and seeing what's going on. But obviously for those of you who are on tracker rate mortgages, you would have seen your rates come down by 0.25%, which is absolutely wonderful news. So on that note, I'm going to leave you to it. We have got a webinar coming up, which is going to be really good, which is going to be covering off the Renters' Rights Bill. I really encourage you to have a watch. We've got some fantastic speakers. We're going to be speaking to a solicitor who's going to advise you how the change is going to impact you from a legal perspective. We've got an insurance guy coming along who is really, really knowledgeable. Particularly, I think he would be interesting to you in regards to the tenants' rights to have pets in properties, which I know is a very contentious one. And we've also got a lender coming in who's going to talk about how the potential or how the changes from the Renters' Rights Bill could impact mortgage lending going forward. So if you haven't subscribed to the webinar, please do. We'd love to have you along. Have a fantastic week, and I'll see you again same time next week.